78%. That is how much of the NASDAQ simply evaporated between March of 2000 and October of 2002. Not one unlucky stock. Not one bad sector. The entire index, 5,000 companies, the whole face of the new economy, lost 78 cents of every dollar it was worth. If you are wondering how something that big even happens, you are asking the right question. In total, roughly $5 trillion of market value vanished into thin air. That was retirement accounts, college savings, stock options that employees had planned whole lives around, and thousands of companies that simply ceased to exist. And here is the part that almost nobody tells you when they tell this story: getting back to even took 15 years. Not 15 months. 15 years. So by the end of this video, you will see exactly how the greatest bubble of the modern era inflated, what the top actually looked like from the inside, which famous companies were destroyed and which survived, and one twist at the end that most people get completely wrong. Every number you are about to see is real, from the actual index history. Let's start in 1995.
Here is the NASDAQ in 1995, sitting at about 1,000. The internet is brand new. Netscape has just gone public, and its shares nearly doubled on day one, a starting gun that Wall Street heard very clearly. Over the next 5 years, money floods into anything connected to the web. Watch the line. It doesn't just rise. It accelerates. By 1999, the index is climbing almost vertically, and in 1999 alone it gains more than 80% in a single year.
600% in 5 years. To put that in perspective, a market that doubles in 5 years is having a very good run. This one went up 7-fold. Companies with no profits, and in some cases no revenue at all, were worth billions on the day they listed. Startups bought Super Bowl ads before they had customers. Adding .com to a company's name could move its stock double digits. Profits didn't matter. The story was everything, and everyone believed the story. March 10, 2000. The NASDAQ closes at 5,048.62, the highest close of the entire era. And here is the eerie thing about market tops: nobody rings a bell. There was no single piece of terrible news that day. The buying simply ran out of new buyers. Interest rates had been rising, the hot money was fully invested, and the most expensive market in American history just stopped going up.
And then gravity turned back on. At first it looked like a normal dip, the kind that had been bought every time for 5 years. It wasn't. By the end of 2000 the index had fallen to around 2,400, down more than half from the peak. 2001 brought the telecom collapse and September 11th. 2002 brought the accounting scandals. And in October of 2002, the NASDAQ finally bottomed at 1,114. 31 months from peak to bottom. That is the part crash stories always compress. This wasn't one dramatic Black Monday. It was 2.5 years of steady, grinding losses, rallies that gave people hope, followed by new lows that took it away. Anyone who bought the top and held to the bottom lost 78 cents of every dollar. Now let's walk through the graveyard and see what that looked like company by company. Pets.com became the mascot of the era. It went from a $100 million IPO to liquidation in under a year. But the real story is what happened to the giants. Cisco, a genuinely profitable company selling the hardware the internet ran on, fell 88%. And Amazon, yes, that Amazon, fell 93%, from around $100 a share all the way down to about $7. And notice something important here. These were not all frauds and sock puppets. Cisco made real products and real money the entire time. Its business never stopped growing. What broke was the price, a price that had assumed a future arriving faster than any future actually can. That is the sharpest lesson of the whole era: a valuation is a promise about the future, and when the promise gets too big, even a great company cannot keep it. Now the chapter everyone forgets, the recovery. Or rather, the wait. The NASDAQ crawled out of the 2002 bottom, took 5 years to merely double, got knocked back down by the 2008 financial crisis, and then ground higher for another 7 years. It did not see 5,000 again until April 23, 2015. Counted on the chart, that is a 15-year round trip back to a number it had already reached once. 15 years to break even. Sit with that number for a second. If you were 40 years old at the peak, you were 55 when your index fund finally got back to zero. An entire chapter of a working life, spent recovering. Time is the hidden cost of buying a mania,
and it is the one cost that never shows up on the label. Markets always come back, people say, and they usually do. The question the dot-com era answers is, when? And for some, 15 years was the lucky outcome. Investors who bought Cisco at the March 2000 peak waited more than 20 years to break even counting every dividend along the way, while the company itself grew its revenue year after year the whole time. Great company, terrible price, decades of waiting. Those three things can all be true at once, and that combination is the most expensive lesson in investing. But here is the twist, and it is the reason this story is worth 10 minutes of your life. While all of that wreckage was smoking, the single biggest winner of the entire internet age was lying right there in the middle of it, marked down 93%, dismissed by nearly everyone, and trading for the price of a movie ticket.
Amazon. $7 a share in 2001. Analysts openly debated whether it would run out of cash. It survived, kept building warehouses while its rivals died, and went on to become one of the most valuable companies in human history. Look at where that line ends compared to where it started. The bubble's believers were not wrong that the internet would change everything. They were early, and in markets, early and wrong feel identical for years at a time.
That is the strangest verdict of the dot-com era. Every wild promise from 1999, shopping online, video on demand, everyone connected all the time, every single one of them came true. The internet really did change everything, exactly as the bulls insisted. The bubble was not wrong about the future. It was wrong about the price of the future, and about how long the future takes to arrive. Those two mistakes cost $5 trillion.
Every generation gets its own bubble, and every generation is certain that this time is different. That is precisely what makes it a bubble. So here is the question to sit with tonight. Somewhere in today's market there is a chart that looks exactly like the NASDAQ in 1999. Which one do you think it is? Tell us in the comments. The best answer becomes a future episode. And subscribe, because money makes a lot more sense when you see it in numbers.